If you're within 10 years of retirement or in retirement, a Roth conversion could be one of the best tax moves you can make. On the other hand, it could also cause you to pay more in IRMAA or Medicare surcharges and increase the tax rate on your Social Security. This could cost you thousands of dollars a year. Most videos just talk about filling the tax bracket that you're in when you do a Roth conversion. They fail to talk about the other factors such as IRMAA or what you'll have to pay in Medicare premiums, what the tax impact will be on your Social Security income, and also how a Roth conversion can affect your RMDs, and how all of this changes year by year. In this video, I'm going to show you on screen how professional planning software brings all of these moving parts together to find the optimal Roth conversion window and remove all of the guesswork. Hi, my name is Zach Poitra, and I'm a fiduciary financial advisor based out of Colorado Springs. I work with people who are 55 years and older, approaching retirement or in retirement. Every week I sit down with couples who had done Roth conversions using rules of thumb that they saw on the internet or other sources, and they didn't realize until we ran the numbers for them that they had accidentally triggered Medicare surcharges and also increased taxes on Social Security income because of the Roth conversions. My goal today is education. This video is not tax advice, nor is it investment advice. Please go speak with a licensed professional before you make any decisions as it relates to your taxes or investments. The usual Roth conversion story that you hear is oversimplified. What you hear is that IRAs and other pre-tax accounts, they're bad because you're going to have to pay a huge amount of taxes later. On the other hand, they say that Roth conversions, they're good because you pay taxes now at a lower rate so that you don't have to pay higher taxes later. So just convert as much as you can while you're in a low tax bracket. Now, there is a grain of truth to that simplistic story, but it's not looking at the entire picture. Here's what is actually happening when you do a Roth conversion. You're taking additional income through the conversion, and that income shows up in your adjusted gross income. And then that number flows into what you'll have to pay 2 years from now in terms of Medicare premiums. It will also flow into how much you'll have to pay this year in terms of taxes on Social Security income. Finally, that withdrawal or that conversion will affect what your RMDs are going to be out into the future. So a good Roth conversion plan is not simply filling up that 22% tax bracket this year or next couple of years. It's more like optimizing lifetime after-tax income while avoiding those hidden cliffs along the way. Now let me walk you through the main landmines that people miss. The first one is focusing on tax brackets now versus tax brackets later. Conversions raise your income in the year that you do them. That part everyone talks about. What most people skip is the future. What tax bracket will you likely be when RMDs come along when you're 73 years old? What happens when a married couple who is used to filing together at a lower tax rate, when one of the spouses dies, the second spouse survives and is receiving a similar income as before and is now filing as a single person? Good planning compares pay some tax now on purpose versus paying more tax later, possibly at higher rates on larger account balances. And then we need to talk about Medicare surcharges. And this is what they call IRMAA. Medicare looks at your income 2 years back. If your income 2 years back crosses certain thresholds for Medicare, your premiums for parts B and D can jump. A Roth conversion that looks fine from a tax bracket standpoint can go over those IRMAA thresholds and cost you thousands of dollars more than you expected in Medicare premiums. And then there's taxes on your Social Security income. Sometimes doing a Roth conversion can cause the taxes you pay on the income you receive from Social Security to increase. And what this really means is that the tax bracket that you think you're staying under is actually higher than it appears to be because of the extra taxes on Social Security. Now let's talk about required minimum distributions, or RMDs. As you probably know, you're going to be required to start withdrawing money at age 73 from your pre-tax accounts. Now, these withdrawals are forced. You have to pull this money out and pay taxes on it, whether or not you need it at all. And that income is going to stack on top of your Social Security and on top of any other retirement income like pensions or withdrawals from your other accounts that you have coming in. And this can trigger IRMAA surcharges, and it also comes at a time where you really don't have the ability to make adjustments and avoid those withdrawals and therefore minimize your tax bill. Strategic Roth conversions are one of the main tools that we can use to reduce the RMDs while you have time to make adjustments so that you're not stuck when you reach the age of 73. And finally, there's the other stuff. Many retirees have income that comes and goes. Things like the sale of a property, or maybe the sale of some other type of investment that creates capital gains. And maybe a spouse decides to work a little bit longer in retirement, or maybe go part-time. And this is going to cause fluctuations in income. We need to be careful and aware of these sources of income when we're doing Roth conversions. Doing conversions the same year that you're selling rental property could create a huge tax bill and an unfortunate surprise. Now, I know all of these factors, there are a lot to juggle in your head, and even if you put them on a spreadsheet, they can be hard to track. This is why a lot of people end up doing nothing or just guessing. Now, I don't know about you, but do you think that doing nothing or just winging it, do you think those are good choices? For many people, there is a sweet spot for doing Roth conversions. This is what we call a Roth conversion window. And this is oftentimes right after someone starts to cut back from work or just stops working as they head into the retirement. They haven't necessarily taken their Social Security income yet, and they haven't necessarily signed up for Medicare. On top of all that, they're probably pretty far away from RMDs at age 73. In that ideal window, the taxable income is lower. And because of the lower taxable income, there's more room in the tax bracket to make the conversions from pre-tax accounts into the Roth. And at the same time, stay under those IRMAA thresholds that we talked about. The problem is that the optimal window looks different for everyone. The right amount to convert or do a Roth conversion at 60 is very different than a conversion starting at age 72. And the right amount to convert changes every year because things like the tax code can change, your income can change, and so can your account balance in your pre-tax accounts. This is where the software comes in. Because we have so many shifting parts that change on an annual basis, we need a solid planning tool to pull all these parts together such that we can make informed decisions without any guesswork. Okay, here we are in our proprietary software. This software is the best I've come across thus far. I've worked with other retirement planning softwares in the past, and this really does the best job of providing a 360-degree view of where a family or client is currently and what type of growth and changes will happen throughout their retirement. In this case, we've got a totally fictional example. This is Mike, who's 60 years old, and Sarah, who's 58. They are still both working. They're not going to retire for a couple more years. And this is the home page for this retirement planning software. As we look at this set of squares or buttons here in the middle, this is where they are at currently at 2025. This button shows both investable liquid assets and other assets. The other assets for Mike and Sarah is simply their home. They have $20,000 in a bank account. And then here we have investment accounts, and we have the detail here that they have a regular taxable brokerage account of $800,000, an IRA of $500,000, and Sarah's 401k of $600,000. Of course, since we're looking at Roth conversions, we are concerned about their IRA and 401k, seeing if doing a Roth conversion makes sense for them. This software has a tool called Tax Lab. If I click on Tax Lab, it's going to think for a second, and it's going to make a recommendation. And this is the optimized Roth conversion window for Mike and Sarah, given their current situation. What is recommended is filling the 32% tax bracket instead of just making withdrawals over time. By doing this Roth conversion to fill the 32% tax bracket, they're going to save 8.6% in taxes over time. Total tax savings over their lifetimes is going to be $1.9 million. That will increase their net income $1.9 million. It'll also increase their net legacy by about $863,000, provided they spend all of that $1.9 million. That may be an understatement for the net legacy. Let's look at the comparison between doing nothing and doing a Roth conversion. Well, what does that look like in terms of their tax bill? And then there's a tab here called Total Tax. What it does is it shows the difference between the two strategies. The blue bars are the Roth conversion. This shows how much taxes are going to be paid each year for the Roth conversion and then after the Roth conversion. The yellow bars, that's doing nothing. That's just following the normal withdrawals from the taxable account, tax deferred account, and following that order of withdrawals. As you can see, the Roth conversion, the blue bars, are very big at the beginning because we're doing Roth conversions at the beginning of their retirement process. Then the blue bars are very small because all of the taxes have been paid on those pre-tax accounts, and that means their tax bill is going to go down. Now compare that to the yellow bars. Yellow bars, again, at the front end, they're higher. When they dip down into early retirement, then things start to really pop in 2043 or so onward because RMDs start to kick in and they're having to pull more money from their tax deferred accounts just to live on. And so this is a very clear picture as to what kind of tax bill they're going to have to face every year. The other tab I want to show during this demonstration is the break-even point. And this is really important to consider because the break-even point on a Roth conversion in this particular case isn't until 2049, if I'm reading that correctly, 2049. So that means their break-even point is more than 20 years out. If this couple, if they're both healthy and they have a history in their family of living a long time, then waiting 20 years to minimize their tax burden probably makes sense. If only one of the couple is healthy and has a history of longevity, it makes even more sense because they will have to file as a single person once that first spouse dies. This Roth conversion can really make a significant difference for that surviving spouse. Now, if both spouses are not healthy and don't have a history of longevity in their family, waiting more than 20 years to hit the break even on a Roth conversion may not make sense. There's one situation that it may still make sense, and that is if this couple is very focused on maximizing the legacy that they leave to their kids and grandkids, then a Roth conversion may still make sense. The kids and grandkids, if they inherit a pre-tax account like an IRA or 401k, they only have 10 years to make withdrawals and pay taxes on the money that they inherit in those accounts. And 10 years really is not a lot of time to make withdrawals. Those withdrawals are going to be significant and could really impact the tax bill for the kids and grandkids who inherit those types of accounts. Now, there's just one more thing I want to show you, and that is the tax strategy heat map. This goes through, I'm estimating like 20 different scenarios as to different ways to do Roth conversions, or even different ways to withdraw money from those different types of accounts without doing a Roth conversion. It does highlight the optimal Roth conversion strategy, but it's not a one-size-fits-all situation. Again, there are things to think about like longevity and health to determine whether or not it's worth it to do a Roth conversion. This heat map can be helpful to play around with different scenarios, not just the recommended scenario that the software puts forth. Let's go back to the summary tab. The point here is that Roth conversions can be very powerful. They're not simple, and this is why we use software like this. Software like this removes the guesswork. You can make informed decisions when we work with software that plans everything out on your behalf. So what should you take away from this video? First, Roth conversions are powerful, but they're not simple. You can't just look at this year's tax bracket. You have to look at your entire retirement timeline. IRMAA and the taxes on your Social Security income, along with your RMDs, they're all connected. When you move one lever, it shifts all the other pieces. Using a professional planning software can map all of this out such that you can avoid expensive mistakes and make informed decisions. If you're within 10 years of retirement or already in retirement, and you live in the Colorado Springs area with $250,000 or more in investable assets, here's what I suggest. Each month, I offer a limited number of Roth conversion checkup sessions. And in those sessions, we load all of your data, all of your accounts, all of your assets and so forth into the software. Then we compare where you're at right now, that is not doing anything in terms of Roth conversions. We compare that to several Roth conversion scenarios. And with that, we can show you in plain English and clear visuals what a Roth conversion would do for you in terms of saving taxes, how that might impact your Medicare premiums, and the taxes on your Social Security income. And then from there, it's really up to you. You can take that information that we come up with during our session, implement it yourself, or if you have an advisor you're working with, you can work with them on the project. And then, of course, if you feel like you'd like to work with me, as long as we are a good fit, we can talk about possible next steps. If you feel like that would help you, there's a link below the video where you can book a time with me. Now, I don't charge anything for that initial session, but I don't have a huge number of spaces open, as I need to keep the number of spots limited such that I can serve my existing clients. Again, this video, it's for educational and informational purposes only. It's not tax advice. It's not investment advice. Please talk to a licensed professional such as myself before making any investment decisions. Thanks for watching. I hope you found this information helpful. And if you do like the content, please click the subscribe button such that you can get more videos like this in the future.